Hello, everyone. This is Nika Roback. We're with the Nest Egg Builder. A couple of our Nest Egg people are missing today, if you don't notice. Peggy is on a plane, and Cliff is not with us either today. But we're very excited to have our speakers from Terra Capital, Ray Hyman, and hold on. What's your name again? I'm
Tom
sorry.
Higgins.
Tom Higgins, thank you. I had it and then I lost it. But I'm going to let them introduce themselves because they have years and years of experience and billions of dollars under their belt in acquisitions. They focus in the multifamily sector. But I will let them continue and get started. And then we'll have questions and answers after the presentation and open it up for that.
Awesome. Well, thank you guys so much for having
Thank
us.
you
I'm
for being here.
excited to get into my favorite topic, which is multifamily real estate. We're going to be specifically focusing on the sector of multifamily real estate that is referred to as small multifamily, and we'll get into the details about that in a second. But my background, I'm a real estate developer. I have worked for some of the largest developers in the country. I went and met Ray at Columbia University in New York City. After that, I went and I worked for Rose Associates. It's a luxury residential multifamily developer that has been building buildings in New York City for over 100 years. I worked for them doing large scale multifamily development, as well as large adaptive reuse projects, all institutional grade. The most notable project while I was at Rose that I oversaw was the redevelopment or conversion of the old AIG headquarters in the financial district. It was a 1 million square foot Class C office building that we acquired, renovated. It's been in the news a lot lately, this strategy of buying vacant Class C office, Class B office, and now, some Class A office, and converting it into live, work, play. So you have a hotel component, a residential component, a restaurant, mixed use component. After working at Rose for a number of years, I worked in the public sector. I went and worked for the second largest home builder in the United States called Lennar Corporation. It's a Fortune 200 company. Lennar's really figured out how to build homes throughout the United States. I worked for their multifamily development arm. We did ground up development in New York, New Jersey, Connecticut, and Pennsylvania. I built everything from type 5 construction, for those that are familiar, which is garden style drive up stick product. I also did podium type 3A construction, which is a concrete podium with stick built on top of it, all residential. And then I also did urban infill, which was concrete superstructures. My projects there range from 150 unit projects to 800 unit projects. And now I oversee Terra Capital, the company that Ray and I co-founded. I oversee our real estate development and operations teams.
Hi all, Ray Heimann here. Great to have you all on and see you here. It's a pleasure for Tom and I to be on. My background is more in investment management and acquisition strategy. So after Columbia with Tom, I worked at JP Morgan in their investment banking group. I focused on US real estate and REITs while I was there. I then moved on to Booz Co., where I worked on their acquisition strategy desk and covered just over $3.5 billion worth of corporate transactions while I was there. And finally, I moved on to a private equity fund called Sverica, based in Boston. And there I worked on healthcare, tech, and real estate, and I identified and closed on $750 million worth of private equity transactions. And it's really the combination of those two backgrounds that lets us drive returns for LPs and is the DNA of Terra Capital, is that modern investment management and acquisition strategy that we'll get into a little bit, paired with Tom's best-in-class real estate development that allows us to add a tremendous amount of value to the real estate that we buy. So this is our investment strategy at the high level. What I think is most important to take away from this call is that what we're focused on doing is institutionalizing the lower middle market in real estate, or the small multifamily segment in real estate. We define that as properties that are anywhere from 2 to 15 units. So it's really the smaller apartment buildings you'd see. And what we do is very similar to what single family home aggregators have done over the last 10 years across America, buying hundreds of single family homes, renovating them, and then making them into a large portfolio that is then an institutional grade asset because of how many properties are in it. We do the same thing, but we do it with the small multifamily properties. And it's a more complex space. There are barriers to entry, so it's a little bit more difficult, and entrants have been slower versus the single family home space. But we've found it's a very good niche, and our focus is really specializing in that area. So going left to right here on our investment strategy pillars, we buy 2 to 15 unit properties, many small multifamily properties that fit in that buy box. We add a tremendous amount of value through renovations. We self-manage all the properties ourselves to drive cash flow out of every last unit. And then finally, and this is the institutionalizing part, when we exit or when we sell, instead of selling properties one by one, where we would still do well, instead, we sell as a portfolio, and it's that larger portfolio asset that makes what we do institutional in nature. And we sell to those institutional groups, larger family offices, hedge funds, larger private equity funds, so on and so forth, that are focused in this space. And the Blackstones of the world all have arms that are focused in this area now. And so starting with buy, this space, we like to refer to it as being too big for flippers, too small for developers. And that's really the key for small multifam, is that folks that are small enough that they would be interested in some of these 2 to 15 unit properties aren't well capitalized enough to buy many of them, or really any of them, maybe 1 or 2 in a year, whereas we will do 5 to 7 a month. And then on the flip side, larger investment funds these properties are way below their minimum unit thresholds. And so we have a really nice competitive advantage in that space. And then on top of that, we buy at this point about 70% of our units truly off market. We go direct to seller. And so the combination of those two things, general competitive advantage, buying from unsophisticated sellers in the too big for flipper, too small for developer space, and buying largely off market, allows us to enter this space at extremely low prices per unit. And that's just the start. So then we have acquired our set of properties and we go on to the value add portion.
And I think on the renovation piece, and this is true for all real estate, but very, very true in the small multifamily sector, is that you really need a very standardized approach because, like Ray mentioned, there is complexity around, okay, this one's 2 units, this one's 8 units, this one's 10 units. The only way that you can ensure that you're really driving to that top of market and finish and having a product that the people living in it can be happy with and proud of, you really need to ensure that you have very strict standards and you roll those same standards out and the same finishes out across all of your properties. We store supplies locally in every market we do the strategy in, and we work with local construction partners. Then we provide them with those materials to ensure that we are able to achieve the same finishes for all our properties, so that if you're in a Terra Capital or Terra Homes small multifamily, then you know exactly what you're going to get. And we focus on that, day in, day out. There's a lot of details and a lot that goes into that. It's all accessible on our website, all educational and interesting about the finishes we use, 3D scans of properties we've done. And our team, proud to say that we just completed our 40th value add renovation project. And, we have many, many more to do. So I know I can dive into that, but I think with time we should probably keep.
Yeah, it's a whole webinar unto itself. But the next piece, as mentioned, we self-manage everything. I won't bore people with the details of that, but it's the key takeaway here is that Tom and I started our property management company in New York City, highly competitive, very difficult market to operate in. We are exclusively acquiring in this fund in the Midwest. And so we bring all of that New York City style management to the Midwest to drive cash flow. And it gives us a major competitive advantage exclusively in the property management space. And then finally, we exit. And so, as mentioned, instead of selling properties one by one, we sell as a portfolio. We market with a best-in-class broker. You can think CBRE, JLL of the world, but groups that we know well and that have exited portfolios in our markets in the past. And the key in this part of our investment strategy is that, and if you remember, we bought from unsophisticated sellers and we got really good price per unit at entry. At exit, portfolios have a tremendous amount of competition on them. And so the prices are constantly being driven up per unit, very competitive process. And that's how we maximize our exit price per unit. And that is how we get the maximum reward for all the hard work we put in left to right on this slide. And you'll see at the bottom, we buy at $100 to $120 per square foot on average. We are all in finished with renovations at $150 to $170 per square foot. We drive 5 to 10% plus cash flow improvement just through our property management. And then finally, we sell as a portfolio at $240 to $270 per square foot. So that's really the major value that we can drive by aggregating these small multifamily properties. And when we do that, we end up with a 2.1x net multiple for our LPs. And this is all tied to prior fund performance. And that translates into a just over 23% net IRR for the same.
This is just, and I'll go quickly through this because I know we want to save time at the end, but this is just a great example of a small multifamily deal that is too big for a flipper, but too small for syndicators or typical developers. We were able to acquire this property on market for $600,000, renovate it for $300,000. Today, even in a high interest rate environment, it's valued at $1.6 million. And it just shows that the small multifamily space is ripe for opportunity. And this is just, a great example of one asset. And I will just give you a quick understanding of a typical medium to heavy value add project that our team does. On the left-hand side, these are all from the subject property. This is typically these properties are mismanaged and there's vacancy or there's started renovations and they haven't finished it. Because it's too big of a project for a typical house flipper, we come in, we have teams locally that we've worked on a lot of deals with that know our system, know where our materials are, and can act quickly. And we take the left-hand side and all our projects look pretty much identical to the right-hand side. And, quartz countertops, stainless steel appliances is something that we always use. So this is, I think, one of the most interesting and probably most valuable slides for the group here today. And I'm not going to touch on all of it, but it really comes down to how do you select a market? And every firm and every investor has their own opinions. Ray and I believe very strongly in the way that we pick our markets, and we do it in a very data-driven, zoomed out, defensive approach. We are, unlike our competitors, not looking for supply-constrained markets. We're looking for healthy markets. And for us, what does a healthy market look like? It looks like healthy competition, not over competition. It looks like access to yields, especially in our asset class, where debt is still valuable or still accretive. We can actually achieve yields on our real estate that make sense. They're great cash flow markets. We also like to see markets that have good job growth in recession resistance industries, healthcare, education, logistics, manufacturing, low cost professional service alternatives, accounting, etc. That allows for a very healthy, robust, and recession resistant economy. That's something that we are really laser focused on. And the Midwest now especially provides great opportunity for that. I would also like to mention something that is extraordinarily important, and I'll do it as quickly as I can. But basically, we look for markets that are affordable. And what that means to us is that if you make $100 a year, we don't want people to be spending more than $30 on rent. The relationship between the average AMI, the average median income, and rents need to be in the correct place. in markets where that gets out of whack, rents are now 35, 40, 45% of someone's annual income. It can create an unhappy tenant, an unhappy constituent base in a local municipality or city that no matter if they're red or blue, will push for rent reform with their local leaders because they are getting priced out of the neighborhoods that they love. So we like to be in places where job growth, wage growth, and rent growth all grow together in a good way, where we can still achieve great returns for our investors, and we avoid markets where we're worried about an unhappy renter base that's going to push for rent control, rent stabilization. And that's not saying my political views on it or Ray's political views on it, but what it's saying is investing in real estate, you don't want the landscape to change around you to where you can't reliably do your strategy. And if laws start popping out of nowhere that you weren't predicting, it can make it very difficult to do well by your investors and community.
Strong underlying fundamentals in our markets so that we are driving value from buying well, renovating well, managing well, and then selling to the right buyers, not betting on appreciation and throwing out of whack the overall risk-adjusted reward structure of our real estate platform. So this slide we want to hit quickly because we think that the Terra Capital small multifamily strategy works in all weather, but right now is an especially good time for what we're working on. One, because of our recession-resistant strategy. Part of that comes from the market and picking MSAs that are over-indexed in healthcare, education, et cetera, and that did well through the 2007, 2008 crisis. And you can see on that chart on the right there on the slide that our markets were flat to slightly down while the rest of the US was tumbling out of control. And it extends to other things too. We're very conservative on leverage. We pick locations and sub-locations that are directly next to major sticky job centers like hospitals. And it all adds to a very recession-resistant or resilient portfolio. Second, like most multifamily options right now, we provide an excellent hedge against inflation. Rent growth in our markets is upper single digits, and in one case, low double digits. And meanwhile, our costs stay flat. So inflation actually helps our financial performance over time. But unlike a lot of multifamily operators, we actually provide good protection against rising interest rates as well. And that's simply because our capitalization rate or our yield on cost, which is the dollar amount that comes in each year divided by the total cost of putting a real estate project together, is much higher than where interest rates are. That's not true for a lot of multifamily operators, but it is true for us. And as a result, we are not as affected by interest rates as other folks. And so it's a good way to continue benefiting from multifam, even in a high interest rate environment. Or fear enhances returns for our model. A lot of our sellers are unsophisticated. A lot of them are impacted by recessions or recessionary fears. And already in the last 4 to 6 months, we've seen a tremendous uptick in the number of properties and units we've been able to bring under contract, largely because of recessionary fears. And lastly, we invest on a 5-year investment horizon. 5 years is our hold period. And as a result, right now is a great time to strike when we can get the minimum price per unit and then exit in 5 years when market is on the upswing and we can get our maximum price per unit at the end. I know that this deck was sent around, and so we'll just go through this quickly, but we use Juniper Square for our investor portal. That's a great place to learn more about us. And the deck that we sent out, these links are actually live, so you can click on these different icons and go to these. But we welcome you to look through our data room on Juniper Square. We welcome you to visit us here at usaterra.com, where we have a lot of cool stuff, especially 3D renderings of renovations we've done, so you can get a feel for what some of our projects look like. And then also, please feel free to contact us directly, whether that's via Calendly or email. And we'll go quickly through our fund structure as well, just so that you guys get an understanding of the way that we've structured our investment platform?
Yeah, I think it's a good talking point actually, and can be helpful. So the private investment funds have very different ways they can be set up, and there's really no industry standard except for one or two. And we've done our best to bring our backgrounds at the institutional level and bring that to our friends, family, and investor network. We brought that institutional grade approach. It's it's often referred to as a 2 and 20 structure. So we offer a 7.5% preferred return, which means, and all funds, in my opinion, should do this. We benchmark what, if you were to invest into REITs in, like, on average year over year, what a REIT investment has yielded for their investors has been 7.5% annually. So we offer that as you get all your money back, and then you get a 7.5% return at minimum before any of the hurdles take place. So once you've hit your REIT level return, then you get 80% of the additional profit, and the sponsor gets 20% of the additional profit after that 7.5% annualized return. Being a private real estate investment fund, we make our money and survive off of fees, and that's how we pay our team. So we do a 2% fee on equity committed, and that's what keeps the lights on. And we do the 2 and 20 because that is, institutional grade. And for us, it's more valuable to offer great opportunities for our investors rather than, try to be greedy like some of our competitors with 30, 70, 40, 60, 50, 50.
And lastly, just quickly, we've thrown in a summary of some of the exits that we've done. These have all been in New York, and we've exited just over the last 2 or 3 years. But you can see that based on our strategy, we hit very similar returns profile in New York, and then we do something very similar in the Midwest as well. The returns are, of course, a little bit stronger in the Midwest, mostly because we can buy at lower prices at entry, and then at exit, we get more arbitrage or portfolio premium than we would in New York. But just so that you can see an example of what a small multifamily property looks like from a returns perspective that we have worked on and that we have renovated in the past. And so with that, I think we did decently on time, but we will go into Q&A, and happy to take that however is most convenient. We can either look at the chat or go from you.
Yeah, I like for people to ask the question unless they don't want to. But one thing, can you stop sharing so we can all kind of see each other? That's how Peggy likes to do it. Yes. So there were a few questions that I saw in the chat. I can ask them, or you can come off of mute and ask yourself. Let's see. Well, that was just Brandon. I believe you were the first question. Okay, he doesn't seem to want to come off mute, so I will ask the question for him. It says, how do you find great investments?
Yeah, that is a great question. So we are focused on really these two components. One is picking a part of the market that's underappreciated, where we have a competitive advantage. That is the 2 to 15 unit. That is the too big for flipper, too small for developer area. But the other piece of it is really buying off market, which for us is key, because when we buy a property off market, we tend to see anywhere from a 30 to 40% discount per unit than we would otherwise in an on-market version of that sale. And so we get really good prices per unit by buying off market. How do we do that? We reach sellers through a number of channels. We do cold call, we do cold text, we do emails, we do old school mailers, we do Facebook crawls, we do Craigslist, really any medium that you can imagine a seller might be present. We find them there. And in our market, or across our 3 markets, there are over 20,000 small multifamily properties that fit our buy box. And so we do all the data analytics to find out what those property addresses are, get contact information across all those channels, and then finally make sure that we have good processes in place to get in touch with those sellers and bring back warm leads so that our investment analysts who sit with us here in the office can take up those warm leads and bring them to close. But that's really our acquisition strategy process in a nutshell.
Excellent. Yes. They say in real estate, buy right. That's where you really make your money, is in the buy,
Exactly.
right?
Yeah, I think
So all the effort goes into that part, marketing, and I mean, it's all contingent, a lot on that. And I do like the fact that you're integrated with your property management. That's nice as well.
I think it's important to kind of control your own destiny, especially in an emerging space like the small multifamily aggregation. If you were giving the keys to someone else, it can get away from you,
Right. Well, that's a very important piece of it, is property management for sure in multifamily, one of the biggest pieces. So it's nice to know that that's integrated. His second part, he said that he didn't have a mic, so I'm asking the questions for him. It says, and how do you raise money for these projects? On things like this. You talk to as many people as you can, right? And is this for accredited investors only, or?
Yes, this is for accredited investors. We do have an unaccredited Reg CF version of the fund that invests alongside, but we are predominantly raising just for accredited investors. We raise money mostly from family offices and other real estate private equity funds that are looking for exposure to the lower middle market. So they are not set up to take advantage of what we do or where we operate. And so we get a lot of investors that are, maybe their main focus is LA, or maybe their main focus is 150 units plus, whatever it might be. And they're not in our cross section of the Venn diagram. And so they like being able to generate those higher returns for capital that they have on the sideline. We also do have high net worth folks in our grouping as well. I would say we're probably about 60 to 70% of our capital is from family offices and other real estate PE funds.
Nice. Yes. Yeah, it is fascinating, this kind of small market. Very interesting. I'm glad you came on to explain it to us a little bit more today. Does anyone else have any questions?
We also have a great article that was just written by a colleague of ours. That we can share with your group, that talks about, the interest in the capital markets on small multifamily aggregation. I think it's getting more and more traction recently. There's a version of Terra Capital that's based in California, specifically LA. There's a version of Terra Capital called Carlyle. Well, it's a Carlyle-owned strategy in Brooklyn, New York. So there are groups doing it. We are the only group that I know of that is doing it in Pittsburgh, Columbus, and Indianapolis. But it's a growing strategy for people because of the progress that's been made in property technology. It's allowed the scatter site management and the scatter site strategy to be very effective.
Yeah, and I would mention a couple other things that are nice about the area of the market that we focus on. Yes, it allows us to drive that 2.1x LP multiple, which at a 23% LP IRR is strong, especially in this market for multifamily operators. But it also delivers a tremendous amount of cash flow. So once properties are stabilized, and typically for us, that is really in the 10th quarter of our investment. So at the 2.5 year mark, we deliver over a 14.5% stabilized cash flow percentage, which is a great way to sort of supplement the income with those quarterly cash flow distributions. And that's how often we deliver those. They actually begin in the first quarter of investing, and they grow over time as properties become fully stabilized and leased up. And it's a good way to sort of get the best of both worlds between a strong overall multiple and return, but also significant cash flow along the way.
Nice. Yeah, I've been hearing that those markets are actually pretty good, especially Columbus. You know, with don't they have a huge
Intel.
or that's more Cleveland. That's more Cleveland. I'm thinking Cleveland, Ohio, with the clinic. There was a lot of big things that were happening.
Cleveland, Ohio is clinic, but the Intel plant, that is us.
Yeah, Columbus was the large Intel manufacturing facility.
Okay, right. Yeah, I was getting those two confused. The two cities, yes.
We got asked the questions like, oh, are you investing in Columbus because you're seeing groups like Intel, you know, plant the flag? And I think it's a byproduct of everything else we talked about. If you have a great workforce that has great universities and great healthcare system, I think it's only natural that our Midwestern markets benefit from the reshoring that is happening in America. I'm not predicting it. I'm not saying that, oh, every single manufacturing facility is going to be opening in these markets, but, you know, we're already starting to see it happen. And I think it's, you know, it's a good way to diversify and hedge yourself to take advantage of the Midwest. I mean, the Midwest was the center of America for a very long time, you know, up until the 1960s when steel manufacturing went overseas. But I think as things come back slowly and with the healthcare and educational backbone, it's a very good market for any real estate investor or any investor to consider.
Yeah. Also, he had, how long is the hold? What is the exit, and what happens if there are headwinds for that exit time?
Yeah, so the hold is 5-year hold period from the end of our final closing of the fund, which we would expect to be at some point this summer. The exit and what happens if there are headwinds for that, we've built into the fund documents the ability to extend exit for a short period of time if the market is in a bad place to exit. Frankly, because of where interest rates are and where the real estate market is right now, we expect that in 5 years, it will actually be on an incredibly strong upward trajectory. And so one of the things we're most excited about with this particular fund is that timing. Our last fund also has done extremely well, and we'll be exiting there at some point over the next 3 years. But this fund is extremely well poised with good timing to exit at the top of the market. But if for whatever reason there was some need to extend the exit by anywhere from 1 to 2 years, we have it built into the fund documents that we can do that. And so that's an important thing for many sponsors and operators, because when you invest in a fund, you're not the only investor, you're not the only person that can make decisions for the fund sponsors. And so as a result, it's good to give them the flexibility to go on and extend if needed in order to drive maximum returns. One of the things that's nice about a real estate fund, and specifically a multifamily cash flowing real estate fund, is that whether it's extended or if for whatever reason there was a great opportunity to exit early, at any point along the way, there's good, strong quarterly cash flow distributions that make it a good investment to sit on through that entire hold.
Excellent. Thank you. I do have another question. So you just rent them out and then you're the buy and hold. Is there any time that there is a refinance that you do, or it's just straight that you just wait until it's a good time to sell?
Yeah, so we do refinances once we have completed renovations on projects. Typically, we will enter into acquisitions with a construction or bridge style loan that finances our renovations, which allows us to have a reasonable equity check at entry and doesn't distort returns downward. And so once we have acquired, renovated, and leased up anywhere from 20 to 30 units, we will then refinance into a portfolio level loan. We never cross collateralize across different properties. We think that is unnecessary risk. We stay away from it. But It allows us to bring a large portfolio of properties to a lender and to the market at once. So we get excellent rates versus a lot of our competitors. And when we do that, we get very strong, stable 25, 30-year amort schedule, long-term and stabilized financing. But that is not typically a capital event for investors. We are usually targeting right around or just maybe 5% above where we had financed the property at entry and through renovations. So we're not depending on large refinance in the middle of the project to drive returns. Our returns are truly based on value added during the hold and the arbitrage that we achieve at exit.
Excellent. Thank you. If I invest in this fund upon exit, can I re-up to the next asset and or fund? Let's start with that because this is a long sentence.
Yeah, our goal
Then
is
I get to the next part of that question.
Our goal, there's complexity around the second part of that question that everyone should talk to their CPA or tax advisor about. But our goal is to provide future rollover opportunities for all our investors. We are laser focused on that for our fund one. And when, 5 years from now, that event comes for fund two, our goal will be to provide those opportunities.
We have a very long runway of new markets to add to what we do at Terra. And so we plan to be operating with the same returns profile, same risk-adjusted returns profile, and in similar markets for the long term. And so in short, we will have a fund three, a fund four, a fund five for investors to then put their returns into if they would like to stay along in the same strategy.
Excellent. Thank you. Does anyone else have any questions?
I have a question, Nika, if I can jump in. So you guys had mentioned 20 to 30 units just a minute ago when you were talking about the refinance. So is that also the typical portfolio size when you go to sell? You're selling them as a portfolio of 20 to 30 units, and I'm curious as to how you put those together and what is a buyer looking for in that portfolio in terms of the properties they're buying from you.
So when we roll up our portfolios to sell to a more institutional buyer, it's looking like 150 to 200 unit portfolio. When we go out for the capital markets to get stabilized debt, we like to go out in chunks because we get more interest and more competitive rates, but we're never cross collateralizing any of our assets. So we're never doing full portfolio style loans. We are doing individual asset level loans, but we're offering, hey, mortgage broker, hey, lender, look at 30 units because it's more exciting for them to place debt on a bigger check size.
And to your point, Mark, we might do 5 or 6 of those 30 unit refinances, and that will be in a single portfolio. So it's in a single portfolio, we'll go through that process. Instead of having to go through the refinance process 20 times, we can do it 5 or 6 times, and it works out a little bit better. But I can address the second part about what buyers are looking for at the end. And I'm glad you asked that, because this is an important part of why we get such good price per unit at exit. Buyers in this space are facing extreme scarcity for large scale assets, and they have to buy at least 150 units. Sometimes their threshold is 100, but typically it's 150 units and above. And there are very few assets that fit that bill, especially in our markets. And even then, they don't trade very frequently. And even after that, if you wanted to build ground up, you're talking about 5 years before you can actually start cash flowing, maybe longer.
Can't even do it right now.
You can't even do it right now. So you're infinity years. And so because of all those reasons, there's extreme scarcity, but there are a couple other nice aspects to our portfolio exit option. One is that the cap rate that they can buy at, while it's very attractive to us, we might build to a 9% cap rate and then sell at a 6.25%, 6.5% cap rate. So that arbitrage is meaningful for us. For them, the other real estate opportunities that they're looking at will have significantly lower cap rates, and that will be significantly worse deals for them. So it's a higher yield, higher cap rate option for them. Plus, because it is scattered site, a lot of buyers appreciate the hedged risk. It's in multiple different markets and submarkets. They're not all the risks tied up in a single location that might be in a neighborhood that becomes unpopular over time, or might be next to a hospital that goes out of business. We are next to 10 different hospitals with what they can invest in across 3 different markets, so on and so forth. So really, it's that hedged higher yield type of profile that's very attractive to a lot of buyers. And not to belabor it, but truly many folks are hunting, especially in the Midwest markets, because of some of the recession resistant, steady as she goes attributes that we discussed earlier. And there really is not a lot of better options for them in the 150 plus unit world.
Yeah, I think that was very well said. And I would just add 2 things, or really one thing. It's scatter sites are becoming more attractive for buyers if they're fully quote unquote turnkey, because of the progress that's been made in operations technology and property technology. This scatter site appeal is only getting more and more, as you know, I dare to say it, the advent of AI and other operation technology companies that make things just way more efficient, like everything run by an iPhone, keyless entry, you know, the list goes on. But property technology is a huge part of this that shouldn't be understated.
And we go back to our single family home analog, which is similar to our model, but with single family properties instead of smaller multifamily properties, where that wouldn't have been able to be as successful as it was without the advent a lot of those property technologies. We are able to ride off the coattails of all of that prop tech development and sort of stand on the shoulders of all of that software to help build our portfolio. And it gives us a tremendous advantage at exit too, because all of that infrastructure exists, it's in place, it's not experimental, it's been in operation for 5-10 years, and it's been in operation in our units. So it's a sort of a proven and known quantity where it just wouldn't have been 7-8 years ago.
For sure, yeah. And like in the beginning, 10 years ago, all prop tech was just laser focused on single family. And really, in Buildium, the software we use, RealPage acquired it and opened it up to small multifamily. But Buildium, the software we partner with, is really a champion in the space, and all the integrations that they have and RealPage's balance sheet to invest alongside it. Like we've been very lucky in the sense that we've been able to ride a lot of that momentum. But it's really amazing. I mean, we joke about it, but it's like every 3 weeks there's a new prop tech. You know, we just rolled out across our whole portfolio a monitoring system that is turnkey, that you put on the exterior of your property by your water meter, or in some cases the interior of your property, depending on how the manifold is set up. But it will detect before you get your water bill if you have a leak. It pings you on your iPhone, hey, this address has a leak, it's this severe, it started at 5:48 p.m. on a Tuesday, would you like us to notify your local plumber? You know, it's like, it's only getting better, and we're excited to benefit from that.
That's crazy.
That's great.
Yeah.
That's it. That's so interesting.
Yeah, no Wi-Fi needed. You know, it's pretty impressive.
Wow, definitely. So does anyone else have any questions before we take off the recording?
So I have a question. As with most investors, you know, there's always a horror story or a nightmare. What's one of your most memorable ones?
I have a good one.
Okay.
It was when I was working for a real estate development company. We were building a superstructure, and we were told that we looked at the weather and it was going to be 42 degrees at night, and all of a sudden it dropped to 20 degrees. And if anyone's ever poured concrete on a superstructure, if your drying 14th floor drops below a certain temperature, the concrete doesn't meet its point load requirements, and therefore you would have to rip out a whole floor of the building.
Oh,
Luckily, we had a phenomenal construction management team in place, and we were able to get heating blankets and put tarps up and put space heaters, and we were just barely able to keep the concrete hot enough. But it just, at least from my standpoint, you never fully know what's going to happen, and what you need is great people around you to be able to adapt quickly and overcome challenges. And from my standpoint, that's, look, if you have to rip out a whole floor of a 14, it was a 28-story building, we were pouring the 14th floor. If you had to stop a project and rip off a floor, if it's even possible, it would have, totally stopped the job. So
I can't even imagine the whole floor.
yeah, you'd have to, I couldn't either. And I'm very lucky I didn't have to figure that out. So
Good for you. Thanks for sharing.
yeah.
What is
Thank
that
you, yes.
monitoring gizmo that you were talking about? What is that called?
Yeah, we'll send that around after. We'll send you the link to the website
Okay.
we use to the server.
Appreciate all the great information, guys. Thank you.
Yeah, of course. Yeah.
Hey, yeah, so I think,
Anybody can reach out to us if you didn't get the information, and we can, set up for them to ask any questions if you're interested in investing. So I'm going to stop the recording now. We can still, have a few minutes to
Sure.
things that you might not wanted to ask on recording. So thank you for coming. Again, this is the Nest Egg Builder. We have our YouTube channel. Don't forget to subscribe. And we'll see you next week, same time, same channel. I don't know who's speaking, but you will get an email that shares that with you. Thank you.
Guys.
Thank you. Much appreciated.
Thank you.